This is a video report analysis of Superior Energy Services Incorporated, in affiliation with Burkenroad Reports, an equity research program administered through Tulane University's A.B. Freeman School of Business. Superior's 12-month target price of $34, accompanied by a market outperform stock rating over the same 12-month period, was determined by equity research analysts Shine He, Lauren Gutterman, Megan Guy, Missy Russell, and Richard Yancey. On the agenda for our presentation is a brief company overview, an explanation of our forecasting and valuation methods, and the factors that shaped our assumptions and valuation outcomes. And finally, we end with a summary of our investment thesis. Superior trades on the New York Stock Exchange under the ticker symbol SPN. The company operates in the oilfield services and equipment sector of the global oil and gas industry and is headquartered in Houston, Texas. Superior provides specialized equipment and services throughout the life cycle of a well to the upstream sector of the oil and gas industry. The company provides a variety of both onshore and offshore services. As of November 22, 2013, Superior's stock price is $26.62, with a market capitalization of $4.24 billion based on 159.3 million shares outstanding. Looking back at the previous 5 years, Superior's stock price reached a low of $11.70 in March of 2009 and a high of $41.49 in July of 2011. Superior's stock price fell to $18.68 in June 2012, most likely as a result of mixed shareholder opinions regarding the company's acquisition of Complete Production Services Incorporated in 2Q 2012. Superior operates and reports revenues in 3 different geographic regions: U.S. land, Gulf of Mexico, and international. The U.S. land segment accounted for nearly 2/3 of Superior's revenues in 2012. Within these 3 geographic segments, Superior provides products and services within 4 business segments: drilling products and services, onshore completion and workover services, production services, and subsea and technical solutions. Superior's onshore completion and workover services accounted for 36% of total TTM revenue for Superior as of October 2013, with production services at 32% of total TTM revenue. Drilling products and services accounted for 17% of total TTM revenue as of this date, and subsea and technical solutions accounted for 15%. As of October 2013, Superior realized 12% TTM growth in Gulf of Mexico segment revenues. The solid growth rate over the past year can be attributed to increased drilling activity in deepwater Gulf of Mexico as a result of high oil prices that have contributed to an increase in E&P capital expenditures in the Gulf of Mexico. In the same period, Superior realized 30% TTM growth in its international segment revenues. In 2012, Superior acquired Geolog South America, a wireline and well testing company based in Argentina, and ITS, a cementing services company based in Colombia. Both acquisitions cleanly position Superior within these new and opportunistic international markets without the burden of major infrastructure or implementation costs, and greatly contributed to the substantial growth within the international segment. For our forecast and valuation of Superior, we developed a 3-factor regression model to forecast revenues through 2014. We built our regression model to forecast near-term revenues by using PP&E, goodwill, WTI oil prices, and horizontal rig counts in North America as revenue drivers for Superior. We used a tapered growth rate to forecast revenues for the longer term, beginning with a 9.65% growth rate in 2015 and ending with a 3% terminal growth rate in 2022. We estimated the 2015 starting growth rate of 9.65% by synthesizing Superior's near-term growth rate projections within each individual geographic segment. After reaching a 2-year high of 90 cents earnings per share in second quarter 2012, Superior's EPS reached a low of 40 cents in first quarter 2013. We expect Superior's EPS to increase and stabilize around 45 cents per share beginning in first quarter 2014. During the next 12 months, we expect Superior to maintain a strong cash position. We project a cash total of $422.2 million in third quarter 2014. We expect Superior's operating cash flows to remain healthy and stable in comparison to the company's historical cash flows, thus estimating operating cash flow per share to equal $1.48 in third quarter 2014. We project EBIT and EBITDA figures to drop slightly beginning in second quarter 2014. We arrived at our 12-month target price by utilizing a weighted average price from three carefully selected valuation methods that include a DCF, price to earnings and enterprise value to EBIT method. Our DCF model generated a target price of $39.41, with our price to earnings multiple method generating a target price of $26.55, and our enterprise value to EBIT multiple method generating a target price of $37.80. We weighted our DCF and price to earnings methods equally at 40%, with a 20% weight assigned to our enterprise value to EBIT method. Given all of these factors, we project a 27.72% increase in stock price over the next 12 months to reach our weighted average price target of $34. There are three main factors that we considered when determining our assumptions for our valuation tactics for Superior. We looked at external factors such as industry trends and peers, internal factors such as Superior's internal capabilities, strategies, and current financial position, and risks within the internal and external environment of Superior. Industry trends consist of overcapacity in the mature U.S. land market, which has led to a decrease in U.S. natural gas prices and an industry-wide margin decline in oilfield service companies. High oil prices have increased E&P capital expenditures and drilling activity in the Gulf of Mexico, and the stagnant U.S. land market has forced many service companies to seek additional opportunities abroad. We chose Superior's peers using the following criteria: similarity to Superior's product and services mix, market capitalization, and geographic scope. Looking at Superior's ratios compared to its peers, the company's price to book value and enterprise value to EBITDA multiples are slightly lower than its peers, thus indicating Superior's stock could be trading at a discount. Superior's debt to equity and return on equity ratios are at relatively healthy levels, right in the middle of the pack of its peers. Superior's internal capabilities consist of a well-diversified products and services mix that allows the company to appease a diverse range of customer needs, a strong international business presence in regions such as Latin America, Asia Pacific, and West Africa, Superior's ability to retain key employees through incentive plans, its ability to hedge against interest rate risks through forward foreign exchange contracts, its ability to maintain a strong cash position that in third quarter 2013 prompted Superior's board of directors to approve a share repurchase program that will go in effect in first quarter 2014. And lastly, the company's ability to consistently access credit markets and maintain healthy leverage ratios. Superior's strategic vision consists of a focus on maintaining a well-diversified mix of products and services, growth in high-margin business segments, capitalizing on short-term growth opportunities in deepwater Gulf of Mexico, and on a long-term front, expansion into opportunistic international markets such as Latin America and Asia Pacific. In conclusion, Superior will benefit in the short term from active global oil and gas markets and increased drilling activity and high margins in deepwater Gulf of Mexico. In addition, Superior's international positioning and expansion strategy provides sustainable long-term growth opportunities for the company. Flat growth in the U.S. land market should be a concern for investors. However, we do not expect the stagnant industry situation to have any long-term adverse effects on shareholder value. Superior's dedicated focus on growth through its high-margin segments and international expansion will help to offset any future declines in U.S. land profits. Disclaimer: the Burken Road reports are produced solely as an educational program at Tulane University A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Thank you very much.